Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. And on today's podcast, I'm happy to welcome Adam Seessel, who's founder and managing member of the Gravity Capital Management, and is also the author of the recently released book, Where the Money Is: Value Investing in the Digital Age. So, Adam, thanks for joining the podcast today.
Anthony, thank you for having me.
Anytime. So, I guess my first question is, what was your influence for writing the book?
Well, the influence, Anthony, was pain, deep psychological and financial pain, in the sense that I was a value investor, remain a value investor, but was doing, sort of old school value investing, buying stocks whose primary virtue is that they were cheap, old school, old economy companies like television stations here in the States, and oil equipment companies, and companies that manufactured railroad cars and so forth. And that approach had worked for me for almost 20 years. I got on Wall Street in '95, but around 2015, that approach suddenly stopped working. And I went into a tailspin of 2 or 3 years of really bad performance. And so I had to sort of recalibrate my instruments and say, what am I doing wrong? And like most value investors, I turned up my nose at tech stocks because they were unpredictable, and they were fast growing, but they almost always blew up, and very hard to value them because they had little to no earnings. So I sniffed at them like most of my value brethren. And I said, well, wait a sec, Amazon and Alphabet and other lesser known companies like Intuit and Adobe were really building consumer-based valuable platforms that had every bit of customer loyalty as Coca-Cola and Gillette had in the late 20th century. I said, geez, what am I missing? And so I reset, recalibrated, and came up with a new value-oriented framework, a framework that tries to marry sort of the best of value investing, of 100-year discipline, given to us by Ben Graham and then his student Warren Buffett, but that also sort of widens value investing's aperture to include this new digital economy, which I think even the biggest mossback on earth would say is here to stay, and is probably going to create much, if not most, of the incremental economic growth in the next generation or two.
Yeah, and how hard was that? Because I think in the book you mentioned how, you really struggled to change. And I think you try to talk to it with other people. I think it was a Berkshire Hathaway shareholder meeting, and they just ignored it completely.
Well, yeah, it was hard. It took a few years, because my approach had worked for 20 years, and for me personally, and then the approach had worked for 80 years for Ben Graham and Buffett and so forth. So it's very hard to reevaluate. I say, it's value investing is kind of like a religion. It has tenets and adherents, and there's different schools and different orthodoxies, but we all basically believe the same thing. And one of the to go against many of those core principles was difficult, but in the end, the evidence is so strong that these new digital companies are here to stay. They're the best businesses that have ever walked the planet. And if we as investors don't learn how to value them in a disciplined, value-oriented way, our returns are going to suffer.
So there's a whole section about what are the key tools for picking the winners. I'm guessing, can you maybe give us a brief overview of the tools and how they have evolved throughout your career? Because I'm guessing they've changed since you sort of adopted this new hybrid approach.
Yeah. Well, let me start at the end, and let me start by saying how I evaluate them now, because I think that'll be most useful to your listeners, but we can get into the history too. But look, I have three main variables, the quality of the business, the quality of the management, and then the price you're being asked to pay. So I just simplify that and say BMP, business management price. So in my framework, business is by far the most important variable, because business quality will win out. Peter Lynch wrote his bestsellers 30 years ago, and he said, a quote that'll always stick with me, in the end, superior businesses will win in the marketplace, and their performance will be reflected in the stock market. And mediocre businesses, the same thing will happen. So if you have a good quality business, it's going to grow over time. And that's where the whole concept of a moat comes in, extremely important. And this is an old Buffett concept. What businesses have a good business and have had competitors that have tried to dethrone it and take away some of their profits and have failed? That's the most important question, is the quality of the business. Then the quality of the management, obviously important too. If you have a great business, but an idiot who's running it, they can really destroy a lot of value. And then there's the price. And the price is an interesting variable, Anthony, because basically I learned in my deep dive into tech stocks is one reason they look so expensive and have looked expensive all the way up. I mean, Amazon hasn't earned money for about a third of its life as a public corporation. One reason they look there's two reasons actually that they look so expensive. One is sort of quantitative, which is GAAP accounting. Here in the US, we use GAAP accounting, but also in Europe, European accounting. GAAP accounting was created, was created in the industrial age, when GM and US Steel ruled the economic landscape. And tech companies function in very different ways. For example, when GM builds a steel plant, or an auto plant, I should say, they can depreciate those investments over 20 or 25 years. But when Amazon builds, improves its e-commerce website, it has to expense that spending immediately, 1 year. When Google improves its search algorithm, it expenses that 1 year. So I say in the book, if a tech company has $100 million of R&D spend and $100 million of revenue, they made zero. 100 million minus 100 million. But if an old line industrial company spends $100 million on a factory, and they depreciate it over 25 years, their expense is 100 divided by 25 is $4 million. So they made $96 million. So that's one reason why tech companies look so expensive, is because the rules punish them unfairly, in my opinion, for just the nature of their business and how they go about investing money. I think that over time we will see the SEC and the various rulemaking authorities realize this, and they'll change the rules. But as it stands now, the published earnings of tech companies are not what their underlying earnings power is. And then the second reason, Anthony, that the tech companies look so expensive relative to others is they're spending so much more to build out to the future. So to compare Amazon with, say, Wells Fargo, a mature bank, I say in the book, it's like comparing an apple orchard in the springtime to comparing an apple orchard in the fall. Wells Fargo is the orchard in the fall. It's in harvest mode. It doesn't need to grow anymore. You need to pick those apples. So every dollar of income that Wells can bring down to the bottom line is bringing down. Whereas Amazon has, 1% share of worldwide retail commerce, 1%. Everyone says, oh, it's so big, it's so big. It just started selling as much as Walmart did. So there's tons of room for it to grow. So it makes sense for them to reinvest in distribution facilities, in software, and all sorts of initiatives. And this also drags down their earnings. And so, if we really want to compare Wells Fargo's earnings to Amazon's earnings, we need to make adjustments to take into account, one, the accounting differences, and two, the fact that one is in reinvestment mode and the other is in harvest mode. It's a bit of a long-winded answer, but investing ain't easy. So I had to go down fairly deep.
Yeah, it's fascinating. And I think I've never thought of it that way, but it makes so much sense, as you said there, that, due to the accounting mechanisms that the normal value companies can use, they're actually taking advantage of it, whereas the tech companies can't. So are there any other sort of mechanisms like that are different between the two types of companies, or is it mainly those two?
No, it's mainly, R&D and marketing spend are expensed over 1 year. Like Intuit, for example, um, they essentially think of marketing spend as an investment, a long-term investment. So they have they say that for every dollar of marketing or that they spend to acquire a customer, they expect to get $3 of revenue off that customer over the lifetime value. So 3-to-1 ratio. And if you put a 20% profit margin on that $3 of revenue, that's 60 cents of profit for a dollar of investment, for a 60% return on investment, which is fantastic. 15% ROI is quite good. So to get 60% is awesome. But that never shows up in the financials because the marketing spend is in the profit and loss statement. So Intuit recasts its financials to capitalize its marketing spend. And some people say that's magical thinking, and I just say that, well, that's just wrong. I mean, there's examples in history where Buffett has basically done the same thing. I mean, when he bought Geico, when he took full control of Geico in the late 90s, he ended up spending as much on marketing for Geico as they had made in a few years ago. So I think the numbers were in 1995, Geico as a public company had reported $250 million in net income. And in 1999, when Buffett took control, he was spending $250 million just in marketing. So did that mean that Geico was earning nothing? Well, yeah, on paper, but he knew that every dollar that he was investing was going to acquire customers at a very attractive rate. Similar metrics to what we just went over with Intuit. So he says in the annual, he said, yeah, I'll report lower earnings, but the value won't be any different. It'll be more, actually. So, you have to really be careful about confusing what you see in black and white on those public financials with what the actual earnings power of a business is.
Yeah, it's like looking at the cash flow rather than looking at the actual, capital gains and the growth
There
of the
are
company.
all sorts of distortions, and I and many others. It's not just amateur listeners in the podcast who can be bewildered by this. I mean, in fact, pros sometimes are more at a loss because we're so used to looking at the published financials and saying, well, those are the numbers. That's the truth. That's the reality. Whereas if you study accounting, you understand that all sorts of assumptions are embedded in accounting. Ben Graham wrote 100 years ago that, be careful with this account and that account because they're estimates. So in truth, the accounting is squishy. The numbers are squishy, which again is why business quality is so important, because earnings can be X, earnings can be Y, but in the end, what really matters is, what are the earnings going to be in 5, 10, 15, 20 years? And that's where business quality matters. That's where the moat matters, because the moat will protect those earnings and allow a company to grow without competitors taking its profits away.
Yeah, which is very important. And I guess, as you said, a lot of experienced investors struggle to change, because I think you mentioned the book, how you talked to one of your mentors and he said, this time it's different. Whereas I think it's the famous last word sometimes, but it does seem to be holding up. So I guess, how do people know when it is different? Is it just looking at their results, or is continue looking at the changing companies? Or
and I think you almost need to adopt the approach of an intelligent 13-year-old. Like if you and I got together a bunch of teenagers or preteens or whatever and said, like, okay, let's just play a game. We're going to try to compete against Google search. Okay, well, how would we do it? Well, we'd get a bunch of engineers and we'd build a search engine, and then we'd try to advertise the search engine is there. Okay, that's a good first start, but will it be better than Google's? Well, probably not. Will it be faster than Google's? No. Did you know that Google changes its search algorithm twice a day to make it better and faster? Twice a day. Yeah, that's true. Well, did you realize that Microsoft spent $15 billion trying to build out Bing to get, to give Google a run for their money and couldn't do it? No. Did you realize that Amazon hired the guy who built the original Yahoo search engine and tried to replicate that and build search for Amazon? There's very little, it's poorly known. And the guy gave up after a couple of years and he quit and he went to join Google. And apparently Bezos had a huge tantrum, And so he said to his employees, treat Google like a mountain. You can climb it, but you can't move it. So how is this time, so that business is here to stay. 5.5 billion people search on Google every day. Or I shouldn't say 5.5 people, there are 5.5 billion searches on Google every day. So you just have to say to yourself, what's the mode? Like, not even what's the mode, like, let's try to take down this business. Like, who's going to take down Amazon, with its infrastructure, who's going to take it? Like, who's going to take them down? Walmart has tried, they tanked their margins 5 or 6 years ago, and they've made a decent run at e-commerce. They have 7% market share. If Walmart can't do it, like, who can? So you just keep going down the list. Like I never liked Netflix and Facebook, to take a couple of the other mega caps, because like Netflix here again, like 13-year-olds could tell you, well, they got a lot of competition, like they got, Disney and Amazon Prime and Hulu and Apple TV and Paramount Plus and, keep going down the list. So they're spending now $20 billion with a B on marketing, on content. And there's no end in sight to this arms race of more and more people spending more and more money. And in fact, Disney has an embedded advantage because they have a library of content that they've already paid for, whereas Netflix has to keep churning out potential hits. And so you just ask yourself, like, how can a business lose? How can a business's moat be tunneled under? Never liked Facebook because it was never like the best social network. Like, they're never like awesome. Like, people just were on it because everyone else was on it. And when WhatsApp came along, they bought WhatsApp. And when Instagram came along, they bought Instagram. And when people figured out that they were buying their competition and they couldn't do it anymore, like now TikTok is starting to eat into their lunch. And so the company changes its name and pivots to the metaverse. So you can kind of figure it out, but you have to almost think very naively.
You think sometimes people try to overcomplicate it?
Very much. And I know I did too, and whether it's on Wall Street or in, at a cocktail party or among your friends, if you look clever and sound clever, then you that's cool. But if you just say, yeah, Google, no one's going to touch Google, like how complicated an investment thesis is that? Like Intuit, no one's going to touch Intuit. They have 3 times more subscribers than their nearest competitor for their small business accounting software product. They spend 12 times more in marketing and product development than their nearest competitor. And they think they have only a 1% share of their ultimate addressable market for this product, QuickBooks Online. Their largest competitors, they say, are Excel spreadsheets and the shoebox filled with receipts. So like, that's an inevitable business. But what I just told you is not particularly complicated, but it's very lucrative.
Yeah, definitely. I think that's the most important thing to think about, making sure that you have that balance between, and it's crazy to think it is a balance between the value and the growth investing with these massive companies that have basically taken over the world. So if we look at, I guess, the macro trends, some people may be thinking that potentially we might be going back to traditional value with higher inflation and, some of those trends, including deglobalization, onshoring, commodities increasing, etc. Do you think, is that something that you look at, or are you mainly focused on these businesses and making sure that you're analyzing?
Sure, I think about the macro, Anthony. You have to, interest rates are, the single most important variable of any financial instrument's valuation, especially equities. But look, when inflation finally reared its ugly head for the first time in 40 years, I went back and read Buffett's thoughts about inflation because, he is my guru. I think he he hasn't quite gotten the tech stuff the way maybe he ought to have. But, tech companies didn't really gain prominence until he was about 75 or 80 years old. So, I hope I'm as sharp as he is when I'm his age. But look, here's what he said about inflation. The best companies to own in an inflationary environment are asset-light companies because they don't have to reinvest depreciating dollars into physical plant that have pricing power. Those are tech companies. Those are tech companies. So, yes, oil is having a good year and a half, great. I mean, does anyone really think that fossil fuel energy's best years are ahead of them? I mean, really? So no, I don't think that just because inflation is here, it's all over with tech. I mean, here again, forget all the complicated macro and the Federal Reserve this and the Bank of England that. What business is going to be around in 5, 10, 15, 20 years that are bigger than they are now? Those are almost invariably tech companies. Of course, there's some non-tech companies that are going to do well, and I own them and I write about them. Companies like Dollar General, which dominates the corner store market here in the States. Companies like Equifax, which produces credit data for consumers. So these are great companies, and they're not tech companies, but tech is mainly where the value is going to be created. Inflation or no inflation, recession or no recession. Just focus on what Peter Lynch said. Superior businesses win in the end. It really is that simple.
Yeah, I think another quote that you mentioned about his is that buy what you know, but I think you added sort of a twist into that as well. So I'm not sure if you can talk more about that.
Well, it's a very good adage for technology companies because he didn't, tech wasn't a big deal when he was investing in the late 80s, but it is now. And, what I say in the book is, wherever you're working in, whatever niche you're working in the economy, you have an edge over me, over Buffett, over Anthony. You have an edge over 99% of all investors. So if you work in marketing, for example, you'll know whether Salesforce has a moat or not. You'll have intimate knowledge about the competitive dynamics of, CRM software, and that gives you an edge. So you have to buy what you know there. If you work in HR, you'll know whether Workday is the best in class or whether there are others. I write in the book that I have a buddy who is an auditor, and he works with large data sets, and he loves this company, and I'm not recommending it, I've never studied it much, called Alteryx, which is the leader for manipulating data sets in Excel. He swears by it, won't buy cheaper products. He thinks it's the company. So you have to buy what you know. But the twist is, you have to be, careful. In some ways, it's the same as it's always been. You have to be careful because you have to know that this business has a moat. You have to know to a fair degree of certainty that Workforce is not going to be competed away, that Workday is not going to be competed away. Or by contrast, you have to know that, Workday is going to be competed away by this company that I know about that nobody else knows about, and I'm going to buy it.
Yeah, and that's so important. So I guess when would you get to the point where, say, you maybe cut your losses on a trade? What would you be looking at in terms of that? Because let's be honest, we all make our mistakes, and we've all been in that situation. So,
well, I'm a value investor, and I'm used to buying stocks and having them go down initially. That's value investors are like paratroopers. We go into unpopular areas and kind of, fight our way out. So Amazon, one of my favorite stocks that I own a lot of, is down 40% this year. Doesn't really bother me because, what Bezos said about the .com bust applies today. It applies all the time, which is, he said, I came in and I would look at our stock going down, And then I would look at our internal metrics and they were all going up. So he said I was fine. And that's where I would advise your listeners to focus. Like, just because a stock's down a lot doesn't mean it's bad. It just means that people don't like it. Remember Ben Graham's famous maxim that in the short run, the market's a voting machine. It's a popularity contest. But in the long run, it's a weighing machine. It weighs value correctly. So that's your job, is to weigh the value. And a value investor has faith that ultimately that weighing, if I'm correct, will be reflected in the marketplace. So I would only cut my losses if if a stock was down a lot and I realized I'd made a mistake in the analysis. Like, let's say I own Netflix and I saw that their subscriber numbers were falling, or Facebook, and I saw that the subscribers were flat and the engagement was down. I would say, geez, am I really wrong that Facebook has a moat? Why the hell is he changing his name? Why the hell is he spending 10 billion a year on the metaverse? And I would have a serious conversation with myself. Am I wrong, or is the market wrong? And if I'm wrong, I'm selling. If the market's wrong, I'm buying more.
Yeah. Do you think people put too much emphasis on price a lot of the time?
Well, they put too much emphasis on near-term metrics. There's I think Nobel prizes have been given for this discipline of behavioral economics, where, I can't remember the exact stats, but 3 wins in sports feels as good as 1 loss feels bad, So over here, our football, our American football, there's 16 games in a season. So if you start the season 10 wins and 1 loss, and then all of a sudden you lose 3 in a row, everyone freaks out. But you're still 10-4, and that's the way the market is right now. It's like, oh, the market's down 20-some%. Oh, Amazon's down 40%. Well, I think before the crash, not the crash, the correction, Amazon was up 175,000% since its IPO, and the market was up 400%. And now Amazon's up 100,000%, and the market's up 320%. Like, what's the problem, people? Like, if there was something wrong with Amazon, if Walmart was making a run at it, or something was structurally wrong with it, I would be worried and I would change my tune. But Amazon's competitive advantages are as strong as ever. And they're just going to keep rolling. So yeah, people get way too obsessed with the near-term trends, and they extrapolate. If things are going up, it's always going to go up. If things are going down, it's always going to go down. And neither is true. That's the whole concept of Ben Graham's Mr. Market, which I describe in the book. It's Ben Graham had this brilliant insight, like, you and I are partners. And let's just say you, Anthony, are the market and I'm an investor. Well, you're kind of manic depressive. And when things are going well, you're really hyper and you're willing to, buy my share of the business for a ridiculously high price. And when things are going poorly, your mood is in the toilet and you're willing to sell out to me at a ridiculously low price. So rather than being swayed by Mr. Market's crazy moods, we should, exploit them. We should exploit them. We should be selling to him when prices are high, and we should be buying from him when prices are low.
Yes. Great advice, I think. And as you said there, it's looking at those companies that are continuing to grow even during the tough times. And as you said, they're on discount compared to where they were 4 or 5 months ago.
Yeah, look at Amazon. Everyone's saying, oh, they had a flat quarter last year, the last quarter retail sales are down. Well, you know why? Because a year ago, their sales grew 45% because of the pandemic. Everyone was at home. So, but if you take 45% and 0%, which is their last 2 quarterly growth rates, and you average them, their average growth rate over 2 years is 22%. Like, that's not too shabby. But everyone freaks out about the near-term metrics, for long-term investors, it's a great time to get busy. It's just, it does take some training to discipline yourself, because there is a lot of noise, there's a lot of angst, and you have to really train yourself to respond to the market as a manic depressive, and not as, giving you some sort of signal.
Yeah. So what advice do you have for people trying to do that? Do you think it's just looking to long term, or just through experience able to do that? Because I know when I started, I was, that classic person who was buy high, sell low, all that stuff.
Yeah.
But I think the longer I've been in the market,
I just think you have to remind yourself that a couple things. One, just look, all the great investors are what Buffett called inversely emotional. So they train themselves over time to get excited when stuff goes down, and to get a little nervous when things go up. So you have to, realize that this is a trait of good investors, and I'm going to cultivate this trait. And it takes some time. It's like, when you realize when you realize you get angry too much, like, you can't just stop getting angry. You say, well, okay, I realize I have an anger problem, and I'm going to work on it. So that's number one. Number two is, it really helps to say to yourself, like, what is the market? It's just a place where business prices get found out. And if I'm really right on this, I'm going to make a lot of money. I tell a story in the book about my college buddy who just bought Apple. That was his retirement strategy, and it's worked out really well. And every time, and that's sort of the happy ending. But over the last 15 years, Apple's gone down in price by a third. So that wasn't fun for him, but he just hung in there. He believed in the business, and he just sort of was indifferent to the gyrations. And I guess the final piece of advice I would give is, I've lived through now 3 or 4 crises. I've lived through the dot-com bust. I've lived through the great financial crisis of 08, 09, lived through the pandemic, and now we're getting through this one. In every crisis, the narrative is different in its details, but it's essentially the same narrative, which is the world's going to end. It's over. It's over, people. It's over.
This time.
It's over. Like dot-com bust. It's over. 9/11. People never going to travel again. Financial crisis. Financial system is broken. Capitalism's broken. Pandemic. No one's ever going to travel again. Human activity as we know it is going to cease forever. And now, whatever the narrative is now, interest rates, the genie's out of the bottle, deglobalization is over. It's always the same. It's always, what's interesting is it's always different in its details. They're like little image makers. They're like always, no, this one's different because of this and that and this. And here again, you sound more clever. You don't sound that clever when you say, yeah, I think everything's gonna be okay. Like how sophisticated is that? Yeah, I think we're going to muddle through. Doesn't sound very smart, but it happens to have been true for all of human history. So I'm betting with the muddling through, in which case I'm going back to my old playbook, which is buying superior businesses on sale.
Yeah, makes sense. So Adam, thank you so much for your time. So many great insights. And I guess my last question is, what is really the message that you want people to take away from our interview and the book as well?
That's a good question. I hope they buy the book, Where the Money Is, published by Simon & Schuster, available on Amazon, of course, and your local bookseller if you don't want to patronize Darth Vader. So buy the book because it is helpful. It goes into much more detail, about how to implement a new value investing strategy. And then, meanwhile, just, keep on plugging, making money in the 21st century in some ways is the way it's always been, which is buy superior businesses and hold them and let them do their thing. But on the other hand, what constitutes a superior business in the early 21st century is quite a bit different than it was in the late 20th century. So widen your aperture, open your lens to include the digital economy, because it is where the money is.
Yeah, and I think a lot of young people they've sort of been caught between, the exuberance of the growth, but then understanding that, there is need for valuation. So I think it's a key, it's that hybrid model that I think people really resonate with. So
Yeah, and in terms of young folks and millennials, I say in the book that, it's no surprise to me that a lot of younger investors are gravitating toward meme stocks, crypto, and ESG investing. These are all sort of concepts, that sound cool and clever. But if you open the hood and rummage around, there's a lot to be afraid of in each one of those concepts. And I write about that in the book. Probably too much detail for now. We can go into each one if you'd like. But what I say in the book is, look, the millennials are very data driven. So just look at the data. Since for the last 100 years, the American stock market has gone up over about 9% each year. Real estate has appreciated 5% each year. So 9% is a lot better. 9% means you double your money every 8 years. In real estate, 5% means you double your money every 15 years. So you got a lot more doubling going on with stocks. And if you buy a superior business, and you'll get better than the average, and you'll do much better than the average, and you'll double much quicker. So trust the data. The data is that the U.S. stock market, for all its foibles, for all its ups and downs, for all its panics, is the most reliable way to build wealth long term. Since 1988, the median year of the millennial birth year, stocks have compounded at 11%. So even though the millennials have lived through a few crises in their short life, stocks are still the place to be. And millennials have an advantage because they're born into tech. Like, I had to learn a lot of this stuff. You guys, you're born with it. You're born with a cell phone in your hands. So you understand this stuff in much more intimate ways than folks of my generation do.
Yeah, understand that TikTok's the cool new social media. Maybe you should invest in Meta and all those things.
Yeah. I mean, look, I have literally never opened TikTok on my phone. So I know what it is, and I've seen videos of it, and it looks super cool. I mean, it looks much more engaging than Facebook. So I can understand why it's taking users. But you guys are on the forefront of a lot of those trends, and you should take advantage of that fact, because that gives you an edge.
Yeah, and I think that's a great piece of advice to leave it with. So, Adam, thank you so much. If anyone wanted to find more of your work, obviously we mentioned the book, which is an amazing resource, I think. Is there any other, any other of your work online?
Well, I write regularly for Fortune magazine and Barron's, so you can Google, Adam Seessel Fortune, Adam Seessel Barron's magazine, and I'm on LinkedIn as well. So if anyone wants to go to LinkedIn, that is the one social media site that I tolerate in my life.
Not Twitter, none of that stuff.
No. Don't have time for that. Yeah, I understand them. I just, refuse to participate.
Very smart. So Adam, thanks again.
Thank you, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.